You're listening to the Silicon Valley Podcast.
Arun, I'm super excited for today's episode. Now, we've had a couple calls before this. I know your background, but for our audience out there, can you give us a brief introduction of your career up until this point?
Sure. Well, first off, thank you for having me. This is a lot of fun. So I started off my career in the late 90s. I was a web developer for a number of years, co-founded a company while I was in grad school, and promptly failed like within 18 months. And on the back of that, I ended up in Japan. So I spent 6 years in Japan, was part of a private equity turnaround of a Japanese bank. It was fascinating, did a little bit of everything. I started off in operations, I was in technology. And then ultimately I found myself on the finance side and kind of at the tail end of that, landed in New York, was investing in specialty finance companies. And so that's really how I got my start in finance. And that's really how I got my start in fintech. So many of these companies that we're looking at are lenders, and we were looking at lenders and these kind of niche lenders 20 years ago, but they were just specialty finance companies back then. From there, I joined another investment firm. We were investing in banks, did that for a number of years. And then really the genesis of MBM was 2015 when I joined a fintech venture fund out of New York called 10 Capital. And that's where I met my co-founder of MBM. I was recruited to turn around a portfolio company, a data analytics company. It was a fascinating experience. I mean, really the first time that I'd been an operator. I'd been an investor for over a decade by that point. And, we successfully turned it around. It was not a venture backable company. Like it would never, ever in a million years be a unicorn. And what was interesting about the partnership, the investors in the cap table, was that everyone recognized it and said, well, let's just run it for cash flow, which is really not how most VC firms think. And it really kind of got us thinking, me and my partner, that there are probably other companies that kind of have this story behind them. So that was 2015, 2016. I kind of scroll forward. I kind of ended my formal days as an employee in 2018. And I said, that's it. I'm going to go off on my own. So I was an investor. I invested in a company called LedgerX. We can talk about that. That was a great outcome to FTX. I was an advisor to Klarna, and I was helping them launch their buy now, pay later product in the US. So, saw that growth trajectory, 2019, 2020. And then we started MBM in 2021.
Okay, so MBM, what does that stand for? And in this journey, bank. Was there anything in between there? Any side projects or anything that you worked on?
Sure. So MBM is our last names. So nothing fancy there. We really got to the point where we had 15 names on the board, and we just couldn't pick. We were like, we just got to get started. Right? So that's MBM. In terms of the journey, bank or especially finance. I did spend 3 years in the public markets. So I was very much a junior partner, ended up taking over a small cap public REIT. We owned a railroad. It was a crazy story. And, I did everything, like the proxy fights. I was sourcing deals. We were investing in real estate. So we're buying land underneath wind farms and solar farms and leasing them back to the projects. And so I probably spoke to 300 different projects. I was going around the country talking to farmers, and I was a landman. If like in the oil days, right? People would run around and try to get concessions to drill. I was doing the same thing, but trying to buy land for this REIT.
Oh, that's crazy! And in all these things that you're working on, where did you learn the most? Or that, I mean, it sounds like you dabbled in everything, but what would you say contributed the most to what you're working on now?
So the experience at the REIT was really interesting because it was a very small organization. There were only two of us. And so when the organization's that small, you do everything, and you're also in the weeds, right? Like you're signing NDAs, but you're actually negotiating them, which is easy, but you're also negotiating and doing the custody, and you're figuring out like the various law firms and the opinions, and then you have to deal with 2,500 shareholders and like getting the dividend payments out. And then we had a proxy fight. We had a huge litigation. So I was like looking through boxes of records. I mean, literally it'd fill this room, records from 1967. Right? Like, and then this railroad was built in the 1890s by Jay Gould. And it was like part of that era. I mean, it was fascinating.
I was hoping you were going on some story there.
I mean, I'll tell you the story. I mean, so the reason why this was interesting, so it's kind of like how my mind thinks, or how we like to look at the world. So this little company went public in 1967. It was the first REIT in history to go public, first or second REIT, and they owned this railroad, in Pennsylvania and Ohio or whatever. And they're like, hey, we have a REIT, so we should buy more real estate. So the first deal that this company tried to do was, I think it was an apartment building in New Jersey. And it ended up, they didn't do the deal because there was like some mafia link. They were like worried about like the provenance or whatever. So the board got spooked. They're like, we can't do any more deals. we're going to get screwed. And so they did absolutely nothing for the next 50 years. And this company was in the public markets, owned a railroad, and did absolutely nothing. I mean, it was nuts. So we took it over. It was Pittsburgh and West Virginia Railroad. Once again, very much a junior partner there, and turned it to Power REIT. I was there for 3-4 years. We had a litigation in Norfolk Southern who operated the railroad, and it was formative, right? Like I was deposed several times. Like, I mean, it was just kind of like one of those things. Like you go through that, and you're like, okay, now I've seen every spectrum of business, right? Like I've been on both sides.
Oh, that's awesome. Okay, so that leads into kind of today with your own fund. First off, I guess, maybe for our audience, kind of tell us what the investment thesis is, but I'm really curious about getting all the information on raising a fund. We've had countless entrepreneurs on the show. We haven't really dived into raising a fund, which is for a lot of, I guess, Silicon Valley, it's kind of that life cycle. You have a startup, you have a successful exit, you decide, I'm not going to do a second company. It's too hard, but I won't admit that to anyone. I'm going to be a venture capitalist. But we've never really talked about, we had venture capitalists on the show of, I have this fund, this is what I invested, but we've never really talked about that. Hey, you're going out to raise a fund. What's that journey look like? So, please talk about your fund, and then let's go into that journey about, what gets that limited partner, that LP's attention to invest in a fund, how, the thesis, everything. Let's really dive down there.
So I'll start with 0 to 1 is really hard. And so I'll admit it. I think it's very hard to start a company and, get it to the first million, get it to the first 10 million. So we see folks that can do that. And it's, these guys are like gladiators, right? Like they're in the arena. So it's very impressive. In terms of the fund, starting in 2014, 2015, as I mentioned, we were, I met Lauren Bonner, my partner, and we had a portfolio of companies within 10. Some were doing really well, some were not. But the companies that were, kind of not doing well, it wasn't like there wasn't something there, right? Like there was a real product, they had real revenue, real customers, passionate teams, right? Like, sometimes like good management, sometimes not, right? So that's kind of challenging. But they were real businesses. They were just small businesses, right? They weren't venture backable. Maybe they raised a couple rounds, but they're not going to raise that next round, right? Or maybe they've raised a couple rounds and, they're just kind of stagnating. They could raise another round, but economically, it doesn't make sense for the owners of the company, right? The employees, the original investors. And do they really want to do that, right? Like, is that kind of the path or journey that these guys want to take? If they think, hey, the business we might sell for $50 million. And so, we started working on that at 10. We left, I left, and we developed a little bit of reputation, just among our network, started seeing more founders come to us and saying, hey, look, kind of stuck, I'm weighing different options. I'm not quite ready to sell. The acqui-hire is not really compelling today. Maybe it will be. Like I still have a chip on my shoulder. Like I still want to win. And but I don't think that win is going to come by raising another $25 million. So like, what do I do? And so, we saw a bunch of deals. We were talking to a lot of founders, and, the first couple, we were giving advice. We tried to invest in a few. We did invest in one. Yeah, this is a one-off thing, right? Like this isn't like systematic, right? That was kind of our thought. And then as we started seeing more and more of these, we're like, well, wait a minute, like there's something big here. And, and so we started talking to founders, and we're like, hey, here's our thesis. Our thesis is we will back companies that have been venture backed for the most part, that can no longer raise venture capital, but still have a journey ahead of them before an ultimate exit. And, here's how we're thinking about it. It's private equity style because, it's not really venture backable. It's not going to be unicorn. We're not, coming in at these, higher valuations. So we're going to value these companies as they are today, not as they may be, and we'll work with the companies, right? And that's kind of what we want to do, and we think there's like a real idea here. And so we tested it among founders, funds, banks, and folks are like, "You're crazy!" Like this is 2020, early 21. Everything's going up and to the right. You guys should start another fintech venture fund, like Series C. There's lots of money. And we're like, I don't know if we can do that. Like, I come from a credit background. I mentioned the Japanese bank. And so like from a valuation standpoint, I was like the cash flows don't seem to match. Like, I just don't see how I can invest. And so we decided to go for it in 21. And so we launched MBM. We had a lot of positive feedback from, the founder, venture ecosystem. And 21 was a tough year. From a fundraising standpoint, everything was going up and to the right. So it was really the year of raising a new venture fund, not, what we were doing. But we had a lot of backers along the way. We one of our early backers did our strategy in a smaller sense in the 80s with Tom Perkins and like some of the early, kind of venture, names, and did a phenomenal job, right? Like just amazing turnarounds. Not all of these are turnarounds, but just, kind of operational improvements, got them onto the right path, big exits. And so we knew we had something in 21, talking about the journey, but 21 was just talking to a lot of investors, and really some of it was, you get feedback, right? You're like, hey, this is how we think about it. We're like, oh, I hadn't thought about that idea. That's interesting. We were introduced to a lot of people, through meeting these investors. Like a lot of investors didn't invest, but even if they didn't invest, many of them would say, look, we can't do it for XYZ. Like we only do venture, we only do late stage, or we only do this. We can't really bucket you into our program, but go talk to this guy over here. He's great. He's going to get what you're doing, and you'll have a great conversation. And so for us, fundraising has been challenging. Like my buddy likes to say, fundraising has fun in it, but it's not fun. I think that's cliche. It definitely is a grind. Like it's make no bones about it. But I think we've met some amazing folks. We've got an amazing set of LPs at this point, and even the ones that didn't invest have been pretty supportive, or have made introductions, shown us deals. So it's been a good journey.
With that, when you'll hear these startup founders that will have 200-300 meetings before maybe getting a check written, how typical is that for when you're out there raising a fund to have a couple hundred meetings? Is this very similar to startups, or is it completely different?
Very similar. Very similar. We've probably spoken to over 500 folks at this point. I think it also depends on what your strategy is. AI seems to be very hot. ChatGPT. I know you spent a lot of time in that space. It kind of feels like if you're a second time founder and you're like, I got, OpenAI, ChatGPT adjacent business. I don't know, maybe it's like 3 meetings and you're funded. Like maybe it's no meetings and you just put up a website and the term sheets kind of flow in. But if you're doing something really off the wall, right? Which, like if we were just yet another fintech venture fund, maybe the journey would have been a little bit different, right? Like we come from that world, we have the bona fides, but what we were doing is somewhat new. Like there aren't a lot of guys that are doing what we're doing. And so when you talk to someone about something that's new and they haven't heard about it, they haven't seen like other funds, it's not too dissimilar from a company that's trying to disrupt something. Like it's not like immediately evident.
Well, how do you get their attention then?
For what it's unique and novel. So like everyone wants to see the new thing, right? It doesn't matter if you're a VC fund, PE fund, or, like investor that's allocating to these funds. Like the new thing is just interesting. The question is really like, what do you do with it afterwards? What happens in that engagement? Like, oh, wow, this is like really cool, but I can't do it because, this is my box, right? Like I only invest in this box. And it's like, well, I know we don't fit in that box, but we're doing some really cool things.
Well, then how do you come up with your investment thesis to talk to them about their investment thesis and make sure everything matches up? Or are you taking their feedback and pivoting, changing?
No pivots. We really believe in what we're doing. And I think it's a structural element of VC. If you look at the power law, a good VC fund, they're going to get their returns from like one or two, maybe three portfolio companies in a particular fund, right? And so the question is like, what happens to all those other companies that have been funded? And we're talking about tens of thousands of companies. Like it's not, it's not like, hey, there's like just a handful. I mean, it's like a big number of businesses, small businesses, medium-sized businesses that all of a sudden find themselves without access to capital.
I guess maybe my question wasn't so much for your fund, but for other first-time fundraisers when they're having conversations. Like, how do they come up with their investment thesis in a way that they know that or have high conviction that they will be able to raise the capital needed to go out and do what they want? Because
sure,
you'll meet these people that are raising funds and they've been at it for 2 years, 3 years, and you're like, hey, isn't it time to do something else?
Well, so it's interesting you pose the question that way because it sounds very much like an investment banking question, right? So, and I don't mean that pejoratively. Like I've lived that world as well.
Arun, if that's a subtle plug, when I'm not the host of the Silicon Valley podcast, I'm an investment banker, mergers, acquisition, growth capital. Please connect with me on the Silicon Valley podcast. All right, Arun.
Absolutely, he is the best.
that quotation is going on the website. All right.
No, I mean, so the point that I'm making there is like you have to have conviction in what you're doing, right? And kind of if you think about the capital markets, like one way to think about it is like, well, where's the money? And let me go build a product that will absorb money, and that will generally generate poor returns for the people that are investing. That might be good for the manager, but to go out there and say, well, I think I can raise a ton of money over here. Let me go do it. And you don't really have conviction or like a thesis on the value generation. I think that's a recipe for disaster. And for both sides, really, right? Like the investor is not going to do well. Maybe the manager will have some management fees. But, for a first time fund manager, which is kind of what you're describing, really like you have to have that portfolio perform. And kind of chasing the herd is not going to, inevitably it's going to be a disaster, at least in my experience. So I think for us, like I said, we think we're unique capital in the ecosystem. And, the more that we've spoken to investors, it is a relationship game, right? Like you speak to someone for the first time, whether it's an intro or, your friend is like, hey, like I met this guy at a party. Whatever the case may be. I mean, we also have a placement agent, right? That's helping us talk to institutions.
Dive into that a little bit more, because I'm guessing our listeners probably don't know what that is. What's a placement agent? So
placement agent is essentially an investment banker, right? So they're FINRA registered broker dealer. They hang their license on a broker dealer. So this is definitely a licensed activity. Right. If you're, for your audience, if a friend is saying, hey, I can make some intros and give me some, some carry, percentage, that's generally not kosher.
We've definitely had those horror stories on this show of startups going, yeah, I met this one person, an advisor, who said if I gave him 5,000, they'd introduce me to all these angel investors and zero intros came, or the famous, the investors didn't know what they were getting into, and then the deal goes south, and literally, I had a call about a month ago with someone that helped a company raise capital. When the deal went south, they went after this person that made the intros, and the person was like, I just connected everyone to be nice. Like, what? Well, you're not an unregistered funder, and they gave you money, didn't they? Well, they were just being nice about the intro. I was like, so
no, it's a dangerous world. I mean, I think the placement agent that we got specifically is and the reason why we hired him is that we started our fundraising as most funds do. It's your kind of immediate network, right? So it's like friends and family, like one circle beyond that. But for what we wanted to do, we really needed to tap into the institutional markets, and you can cold call and like that does work, but it just takes a lot longer. And so we hired a guy. We love him. He's been great, and he has existing relationships. And so he's been helping us, like navigate, this group is just not going to do it because XYZ. So, don't waste your time. These guys are definitely in, or they've run out of budget. And so it actually is like over my career, I've hired a lot of investment banks for various engagements, and used properly. Like I'm not going to say that like it's not like a universal plug, but like for the right engagement and the structure, it makes a lot of sense. And so anyway, so we hired a placement agent, and really we've barbelled our fundraising. So we have high net worth and family offices, which is really me and my partner are speaking to folks and kind of having those conversations and bringing them along. And then we have our placement agent who's really helping us with some of the larger institutions.
And then the placement agent making the introductions, warming them up, connecting everyone. Then you have to go and close the deal.
We have to close the deal. I mean, that placement agent is not going to close the deal for you. Just like if you are trying to sell a business, banker's not going to be able to close the deal. Like ultimately, management team is going to have to get up there, and tell the buyer like why they should buy the business, like what's valuable. The firm that we hired, they are helpful in the process, right? Like there are a lot of social dynamics that go around. You're speaking to a team of 4 or 5 investors at a single organization. What do they care about? Like what have they done historically? Like that context and just kind of support is incredibly valuable, especially if you're getting off the ground, right? You're getting started.
So your fund's not the typical VC where we get 3 or 1, go to the moon, all the rest fail. It's not the private equity where everyone's got to succeed or they get dinged. How do you go about, like, what are the metrics you're looking for? And kind of what are the metrics that I guess a traditional kind of VC fund would look for and that private equity fund would look for? And how are they different or similar?
Sure. A lot of questions there. So
it's okay.
I'll try to remember all of them.
Pick the one you want. And by the time you're done with it, the audience will forgot what I asked. So.
Yeah, no. These are good questions. So, first of all, like in terms of portfolio construction, we're definitely not VC. So that is kind of 1 in 10, 1 in 20. Yeah, that's a different model. We're very much closer to private equity. And so, from our underwriting, we look at companies, we take a credit lens to investing. So we think about downside. We're building a portfolio that will very much look like private equity. I think, 8 out of 10, 9 out of 10 will be successes. And then we'll probably have 1 or 2 that, something went wrong along the journey. Like a lot of things can go wrong between the time you invest and the time that you exit. But it will certainly look more like private equity. Do I expect a company in the portfolio to do 1,000x? Probably not. Right? We are not, at least at MBM as a PE firm, we are not looking to invest and build unicorns. Those companies are capital intensive. They take a lot of magic and luck. Like we've seen them. We've been at part, of 2 or 3 unicorns at this point. Like it is really hard and takes a lot of capital. And so our approach is really we invest in companies that they have revenue, they have product market fit, and the companies are generally a little too small to really to intrigue a strategic buyer, but they are in the path of consolidation. Like you could see this, a company that we would like kind of grow slowly, certainly not, growth at all costs, but grow into a size that has some scale. And at that point, you could see an exit to a strategic. And it really is a private equity style exit.
Well, then I guess with that, what are the things you're looking for as the value drivers for that company? Is it EBITDA focused then? Is it, because you mentioned it's not growth. So kind of what are those things you're really looking for in that company? Or is it just hey, do we already know where the exit could be? Let's match those up.
So it definitely is growth. It's just not growth at all costs. So it's, how do you grow sustainably? And I think like what we see with a lot of, venture-backed companies is, there's this concept of blitzscaling that's really taken over. I forget when the book came out, 10 years ago, 8 years ago. And there's this idea that you're going to invest aggressively. And what that investment is doing is really pulling forward growth, right? So like pre-blitzscaling, and for most companies, you'd grow like within your means, right? You've raised some capital, but maybe you'd grow over 3 years into $20 million of revenue. Now folks are trying to get there, from 3 to 20. They're trying to do that in 12 months, right? Or maybe it takes 4 years. And so you're really investing aggressively, which means that you're burning, capital, right? You have, kind of negative EBITDA, and you're pulling forward that growth. Now, for some companies that makes sense, right? And some industries you might say like, look, if we don't get these customers now, our competitor will, and we'll never get them again. And the industry is too small and it's going to be winner take all. But not every business is in a winner take all situation, right? And so, we just spoke to a company 2 weeks ago. I was talking to the founder. I was like, your business plan calls for 100% year over year growth for the next 3 years, which means that you need tens of millions of dollars. What if you grew 30% a year, for the next 5 years? Right. And you would almost get to the same level. Like, what's the market dynamics? Like, if you told me couldn't do that because, our competitors will steal all our customers, we'll never be able to get them, the switching costs are too high. Like, okay. It's like, yeah, no, we could do that, but I didn't even realize that was an option. Because as venture investors have invested at such a high level, that they need that growth, and the amount of capital that's being burned, given that's what they need, means that they need that growth to raise that next round of capital. And we're like, well, what if we put a check in and we grew at 30%, like we would never need to raise again. So you just, focus on execution, right? Like as opposed to like constantly raising, and you just get there in 5 years and not 2 years, but you're more likely to get there. And so that's kind of like, from our perspective, when we're looking at companies, we want to see that they can grow, but they can grow sustainably. Right. And so, free cash flow, EBITDA, we're looking at not just gross margins, but CAC adjusted gross margins. So, CAC adjusted gross margins for some of these companies are negative.
Go into detail with that.
Customer acquisition costs. So, companies that have high gross margins, but their acquisition costs are through the roof. Like, is that sustainable? Like, I don't know. Like sometimes they are, sometimes it's like, yeah, we'll make it up in year 5. Well, that's a bet that we won't take. Other guys will take it. That's like a financial bet. But, we want to see a business model that kind of makes sense today, that has growth, and where we can say, we could reasonably grow this over 3 to 5 years, and then exit, at multiples at that point that are private equity multiples. right? So we're not going into the public markets at 40 times revenue. This is going to be 10 times EBITDA, 12 times EBITDA, right? And does that math work for the amount of money that we are investing and what that, probable exit looks like?
I just like the fact that they're like, wait, that's even a possibility.
That was like, I didn't realize that was a possibility. I was like, and it was stunning to me. And this is a company that has like just putting it in context, seasoned board, right? Like, really solid folks, guys that I respect. And he's surrounded himself with a smart team. Has sold a prior company, like has had and just like that mentality that you've got to always blitzscale. Not every company needs to blitzscale. And some companies that have blitzscaled no longer can continue to blitzscale, right? And so that's kind of where we come in, right? We're looking at these businesses. They have, good product, a good roadmap for where the product's going. And they have real customers that are paying, real dollars and for the product. And, that should be a business that even though venture funds, may no longer say, hey, I want to support it, for the next 2-3 years and additional rounds of capital, it still should be a business that gets funded and maybe it moves from venture to private equity. And that's where we step in.
Where do you see family offices playing in this space?
So from our perspective, we see a lot of family offices that have invested in these companies along their journey, right? So the cap tables are generally fairly complex. And, some family offices, if it's a business they know, it's adjacent to, a business that they own, a larger business, they'll continue to fund these companies or they'll, be the acquirer. So that's kind of where we see family offices. I mean, we have a number of family offices that are investors in the fund. I think they like what we're doing, which is really, thinking about fundamentals and kind of this value investing. It's not for everyone.
And then how are you looking at these companies, or actually maybe not yourself, but just let's go not the entrepreneur side of the table, but the other side of the table. How are the investors looking at these companies in both price and terms? Can you give us some insight on that side?
So, every situation is a little bit different. So I'll just kind of caveat with that. There isn't a one size fits all. We are in the last year, we've been speaking to a lot of venture funds, especially seed and Series A funds. But just really across the board. And I think what we're seeing is for the funds that can't either invest in the company, right? So it might be a venture fund, sees a company that's not in their portfolio and they're like, I love the founder, I love the idea, but we just can't invest. And, here's a set of reasons. They might look at that company and say, look, I don't really think it's a venture deal anymore, right? It may have been. And so we're starting to see deal flow and sharing ideas that way. For the funds that are in the portfolio company, right? They're on the cap table. I think there's kind of like I don't know, it's like a multiple stages of grief or, like whatever the steps are, that is like the 9 steps or the 3 steps. And, I think by the time we're speaking to a company or a venture fund, that they realize they got to do something. Folks have come to grips with like reality, right? Like this is not, maybe the company's tried to raise for the last 12 months. Maybe the founders have gotten some, bridge notes. We're seeing, kind of through COVID, a lot of the venture funds have really supported their companies. And so there've been, a couple rounds of bridge notes, through kind of 2020 and 2021. But there comes a point where it's like, this is just, we kind of hit the end of the road, right? Like on this path. And so, a lot of venture funds that we speak to, that they're acknowledging that, like, and the deals that we've invested in a company in September. we're looking at a lot of companies. We've gone far in a few that, that we haven't quite gotten there. I think they're realistic about where things are.
Now, without sharing names, is it possible to kind of tell us the details or a little bit of information about a deal that you might have worked on that didn't pencil out?
So there are a lot of those. There was a company that we absolutely loved. I mean, we spent time with the founders. They raised a ton of capital. So, kind of an A, B, C round. SaaS business, great data architecture. I built a data business before. And so, we had our tech guys look at it. I mean, it was just, the product was ready. Marquee, Fortune 100 clients on the other side, and solving a real problem, in the, in their space. And we got really far in kind of the deal structuring, like here's what we'll invest and here's how much we'll own, and, so on and so forth. And the board, right? They're kind of like, okay, fine. Like, we're comfortable with this. Like, we'll own this piece. And ultimately it came down to the personalities that were on the other side of the table. I mean, so much of this business is about the social dynamics and the personalities. Like, you get caught up in Excel. Like, you can make a lot of money in Excel, is kind of what my boss used to say when I was at Shinsei. But, at the end of the day, it is about the people, like who's on the other side. And so, we couldn't get through to the team. Like, you were kind of there, but there was just like a little bit of a dissonance. And, so
that
anyways,
apparent the whole time of the transaction, or was just more towards the 11th hour?
No, that came out towards the end. Like, generally, it's kind of like dating. It is kind of a good analogy, right? Like, like you could go on a first date and, it's like a really bad date and you're like, okay, I'm done. And then you're like, oh, and so you get to know a team as you go through diligence, as you're starting to think about, okay, term sheet is one thing, but I got to translate that into like real deal terms, employment agreements, things like that, right? Which really is kind of a second stage. And so you get to know someone through that process, right? You get to know the team, like how they negotiate, how they, handle the negotiations, right? Like, are they reasonable, not reasonable? So
what you're telling me is the term sheet's just the start of things?
Yes. You've got a big smile. Yeah. I mean, term sheet is, I think it's a useful, document. Like, I don't want to like underplay it, but, as my, as like some of my mentors would say, like, you should be able to like write the terms on a napkin and kind of say like, here's the deal. Right. And whatever's on that napkin, right? Like boxes, or like, here's my, I'm putting an X and here's who's going to, that's like 90% of the deal. Right. And so you're kind of like, okay, we're generally in alignment, right? Like, if you and I were trying to do something, we'd be like, we kind of got it. That other 10%, although like it doesn't matter, it kind of does. And, I've been on both sides. So like, I've been on the other side where like, oh, like this term in my employment agreement, like I can't live with this. Like, this is like preposterous. Like, I would never do this. And so you have to like, you have to come to the middle. Right. And you also have to look at the agreements in whole, right? Like, it's not just one term. It's like in the context of everything. So, long story short, that was one that we were so close, and, it just, we just couldn't get there.
Okay. Now let's go to maybe leave out names as well. The craziest deal you've ever heard of. You've had a long career.
So this is like, I don't know if it's not like a venture or private equity deal, but, so when I lived in Japan, there's like a tax regime there where they tax global income. And the US does this too. However, if I forget the exact details because it was like 20 years ago, but basically, like if a country taxes at like 25%, then they won't tax that income, right? So they're like at 45%. Like if the U.S. taxed the income at 25%, then you don't have to pay tax in Japan, something like that. So this group of guys, super entrepreneurial, they went to a South Pacific island, and they convinced the country to basically tax at 25% as a tax loophole. And so, companies could basically invest through that island to wherever else they wanted to invest in, which, may not have met the 25%. And so they essentially turned the country into this like little interesting fintech. And, and then there was tax revenue, obviously, right? Because, and they got paid a piece of that. So like effectively individuals became taxing authorities through a country. And so that's like, I know it's insane, but like that's like wild. That probably is like the craziest thing I've ever seen in my 25 years.
Oh my God. If you could somehow get one of them on this show. Oh, that'd be amazing. Okay. So before wrapping up, tell our audience a little about MBM. Who would be the best companies to reach out to you, how you work with them, anything you'd like to share about it, please share right now.
Sure. So, we invest in particular sectors. So we're focused on fintech, HR tech, data, SaaS, a little bit of e-commerce on the e-com enablement side. Generally we're looking for companies with $3 to $5 million of revenue. So we want to see some product in market, some product market fit. We're looking at companies that have $25, $30 million of revenue, but at the kind of the bottom end, $3 to $5 million of revenue. And these are companies that should have a viable path to grow, but they don't need to grow at 100, 200%. Like we're very much patient, differentiated capital relative to VC. And so part of the company, part of the diligence, right? That social dynamic is really, are folks willing to change behavior and kind of expectation of outcomes? And so that's like a big part of the conversation is like, look, you've been on this amazing journey, right? 0 to 1, you've got to 10 million of revenue. Like that's hard. Like, and we're not those folks. Like we could not do it. So we respect that. But, getting from 10 to 100, like in the venture journey, that's like one journey. And then we're like, hey, maybe you're going to go from 10 to 25. And that's a different journey. And so, folks that are reaching out to us, they have to kind of think to themselves, like, what is it that they're looking for? And what are they, what's their ambition? And then the last thing I would say is like the folks that we want to back, they really have a chip on their shoulder. Like this is a case of like, look, I want to win, right? Like I want to get to, an exit that's not just an acqui-hire or like, this thing kind of fizzled out. Like I want to win. And I mean, honestly, like we see a lot of guys, they've been in the business 10 years and they're like, I know I've built something valuable. Like, I've spoken to strategics. I've spoken to like, my customer, like we need like a little bit more time, a little bit more growth and we need some help. And so that's the kind of situation that we like, right? Like, folks are like, we're almost there, right? Like it's, we've gone like 80% of the way there and it's another 20%. We need some capital, we need some operating expertise. But we can get there.
And if anyone wants to find out more about you, yourself, your fund, what's the best way to go about doing that? So,
check us out on LinkedIn. I post a lot on LinkedIn. Just reach out. We talk to everyone who comes in.
All right. We'll have Arun's LinkedIn in the show notes. So everyone out there, please go to, any podcast you listen to in the show notes there and on our website at thesiliconvalleypodcast.com. And for our audience, when I'm not the host of this award-winning podcast, I'm a investment banker focused on mergers, acquisition, growth capital. And everything that Arun was mentioned today, all those great comments about investment bankers. We normally only get good comments, so please just please just focus on what he was saying. And with that, Arun, thank you for taking the time this week on the Silicon Valley Podcast.
Thank you.